Hello and welcome back to another edition of Option Strategy. In this video, we're going to discuss the best way to trade Iron Condors. So why do we want to trade Iron Condors? Four main reasons. One, they are a defined risk trade, meaning when you set them up, you define up front before you even enter the trade what your max loss is. So even if the stock market crashes or explodes to the upside, you have a very predefined amount that you can risk on the trade. Second, an Iron Condor is IRA eligible. So you can trade an Iron Condor in a margin account or an IRA account. Third, when you set up an Iron Condor, we set them up to be what we call delta neutral, meaning we do not have an assumption, a directional assumption of which way the underlying price is going to move. And that's important because many times you don't really know, nobody really knows which direction a stock is going to move. Is it going to go up or is it going to go down? With an Iron Condor, you don't have to have a directional assumption. All you want to happen is for the underlying price of that stock to stay within a specific range. And lastly, the way we set up Iron Condors, they are very high probability trades. And what I'll show you is the way that we set them up, we end up winning about 85% of the time. So let's get started. The first step is to choose a liquid underlying. You only want to use trading vehicles on the Navigation Trading watch list when you're trading Iron Condors. If you don't already have the Navigation Trading watch list, come to the website www.navigationtrading.com or send us an email and we will email you that watch list for free. You want to stay in liquid underlyings because you want to make sure that you're in a trading vehicle that has a lot of volume, a lot of liquidity, and tight bid-ask spreads, so it's not eating away at your profits. And you want to look for opportunities to trade an index or an ETF, or I trade a lot of futures contracts as the underlying, and I always look to trade stocks second. The ETFs or index underlyings just tend to be a little bit better and more efficient vehicles for trading. I do trade a select handful of stocks for this strategy, and again, they'll be listed on the Navigation Trading watch list. Step two, we're going to choose a vehicle with high implied volatility. When you enter an Iron Condor, you're entering it, you're selling the options to enter the trade. And so we want to sell those options when they're priced high, and you know they're priced higher when implied volatility is high. So we define high implied volatility as having an implied volatility rank or implied volatility percentile over 50. So once you see that it's hit that level, then you know it's a good time to put on an Iron Condor. When you're setting up the trade, the first step is to choose your window. So options always have an expiration date in the future. The optimal days to expiration that we look to enter a trade is about 45 days to expiration. And actually any time between 30 and 60 days to expiration is sufficient. Next, you want to choose your strikes. So the short put should be at or near the 20% probability of being in the money, and the long put should be placed at a lower strike. The short call should also be placed at or near 20% of probability in the money, and the long call should be placed at a higher strike. Now when I say lower and higher, how much lower or how much higher? And I put a tip down here for vehicles that trade around $100. You want those long strikes to be about 3 points away from the short. So on the put side, you want the long put to be 3 points lower, and on the call side, you want the long call to be 3 points higher. Again, on the navigation watch list, I give you the width that you want to set those long strikes away from the short ones on all the different trading vehicles that we utilize. So let's go to the platform and give you an example of setting up this trade. So the vehicle that I'm looking at right now, before I started the video, I looked through and I found one TLT, which is the bond ETF. It's got an IV percentile of 63, so that's over 50. The IV rank is 41, so just below 50 marks. So this makes for a good opportunity because those options are priced fairly high. So this is trading at about $138.90. So if we go to the trade tab, and remember the window or the time, the days to expiration, we want to be between 30 and 60. You want to stay away from the weeklies because they are not as liquid as the regular option cycles. So the one that falls in between that 30 and 60 days, as you can see in parentheses here, this is 50 days to expiration. So if we open up that set of option chains, you'll see you've got the puts on this side and you've got the calls over here. And so if we go down and under this column, you see the probability of in the money, and right at about 20% probability of in the money, we can right click, and we always enter by selling an Iron Condor, and that'll populate down here. Now it just defaults to the next strikes. So what you have to do is you have to go in and say, okay, we sold the 145 call and we want to buy the 148 because it's 3 strikes higher. So we'll change this to 148. And then on the put side, we look over here and we always, if there's, right here we see there's 18.86 or 22.85, we always default to the one closest to 20% that's higher. So I would default to the 133. So we want to sell the 133 put. So let's change this to 133. And then we want to buy the put 3 points lower. So that'd be the 130. So we change this to 130. And there we have it. We would receive, this is the mid price is about a 91-cent credit. So if we right click to analyze this, so as you can see, this is the visual representation, and with trading one contract, our max profit on this trade would be $91, and the max loss would be $209. The $209 is also the amount of capital that you have to put up to place this trade. And obviously the larger your account is, the more contracts you can do. So if we click this up to 10 contracts, then obviously now the amount of profit potential that we have is $910. And the amount that we have to put up and the max risk that we have on this trade is $2,090. So the amount of contracts that you trade is dependent upon the size of your account and the amount of risk that you're willing to take. So I hope that helps. This has been another edition of Option Strategy. If you would like to learn more information about different trading strategies and how we profit from trades at Navigation Trading, go to NavigationTrading.com or email us at info@NavigationTrading.com. See you at the next video.